So today we're going to talk about Doordash, the largest food delivery service in the United States, and also you guys might know it as the official app of the NBA. It's set to IPO this week, December 8th, with a current market valuation of roughly $30 billion at the top end, which, bear in mind, is double its latest private valuation of $16 billion. So it's going to be listed on the New York Stock Exchange under ticker symbol DASH and begins trading on Wednesday. So the question is it a buy, or should investors be wary of this potential opportunity? So in this video, I'm going to explain what Doordash is. I'm going to give the bull thesis. I'm going to give the bear thesis. I'm going to try to explain whether investors should be excited about the company's upcoming IPO and whether it's a buy. So the company, again, is set to raise $3.1 billion, issuing 33 million shares. So the price per share will be around $90 to $95. So not a cheap stock, but let's dig into the numbers and see if that price is justified. So Doordash has 18 million customers, 1 million workers, 5 million customers on its $9.99 per month Dash Pass service, which means paid customers. That's according to their reports, by the way. Doordash captured 49% of the U.S. meal delivery sales in September. That's up, by the way, from 17% of the U.S. food delivery in 2018, and also compared with Uber Eats, 22%, and Grubhub's 20% of the market. So they're leading. The revenue grew 172%, 214%, and 268% year over year for the first, second, and third quarter of 2020. For reference, Grubhub only grew its revenue by 36% year over year in the first 9 months of that year, of 2020. The company also reported $1.9 billion in revenue for 9 months ending on September 30th. That's up from $587 million for the same time last year. Huge jump. The company also lowered their net loss to $149 million from $533 million over the same amount of time during the previous year. And they also improved, this is important, they improved their margins dramatically from 39% this year to 53%. The company also has $1.6 billion in cash and cash equivalents heading into the fourth quarter of 2020, meaning they have ample cash to fund themselves even without the IPO for now. So in terms of future expansion and growth, the company said that it was trying to diversify into delivery of items other than food and meals. On their Dash Mart, they call it, a convenience store concept they rolled out in about 8 cities. So that could be pretty beneficial in the future for growth opportunity. In addition, they're also looking to a future in autonomous vehicles and delivery systems. So they currently have a testing partnership with General Motors Cruise. And last year, they purchased autonomous vehicle startup Scotty Labs, it's called, for $5 million. So again, while these things are long-term goals, they're also important for long-term investors to take into account because that's going to be their growth story. And that's the thesis. So here are some of the issues. This is where the bears come in. Profitability is one. Doordash is not yet profitable. Its net loss widened from $207 million in 2018 to $667 million in 2019. Like I said, they did cut that margin substantially in the first 9 months ending on September 30th. But that is almost certainly due to the pandemic surge. Obviously, everybody's at home, delivering skyrockets. The company only had GAAP profitability of $23 million in one quarter, which was the second quarter of 2020, and that's during the global pandemic. But think about this. They couldn't even sustain that profitability, and they fell back to a $43 million loss in the third quarter. So let's actually talk about the pandemic. Obviously, everybody knows the pandemic caused everything to go everybody to be in their houses, so of course food delivery services skyrocketed. So Doordash is no exception. In fact, Doordash themselves admitted in their S1 filing that they are unaware about whether they can sustain the level of growth after the pandemic. So that's a significant issue. The other issue is competition. So Doordash faces competition from Uber Eats, Postmates, and Grubhub. Remember, Uber completed its acquisition of Postmates for $2.7 billion last week. But the problem for Doordash, and really any competitor in the food delivery business service, is that there's no differentiating offers between these services. Here, look at this chart. It shows the percentage of users who switch over or at least who are also users of Grubhub, Uber Eats, and Postmates together with DoorDash. So that's a significant issue. The reason for this and these numbers is the low switching costs. In other words, it doesn't cost customers much to switch over to another platform. And that, with increased competition, is a terrible recipe for business. And that's what they're up against, and that's what they're facing. So by the way, to be clear, again, DoorDash is ahead of its competition pretty significantly, but that's not to say that they will hold on to the market share in the future. In fact, the company disclosed in their S1 filing that they fear having to spend a lot on marketing to customers specifically to attract their attention because of this increased competition. So at a certain point, it might not even be worth it for them. So that's an issue. Another unfortunate reality for the delivery business, the food delivery business, is that they compete with the restaurants themselves who offer delivery services to their customers. Think about Papa John's, think about Domino's. They have great delivery services. So, and then also think about Doormart, their future convenience store delivery system, which is going to have to compete with the delivery giants like Walmart and Amazon. So another thing that investors should think about and be aware is the company valuation. So the valuation at this point requires a major leap that has to be addressed. So let's discuss it. In order to justify the current IPO price of DoorDash, DoorDash is going to need to do two things. First of all, it's going to need to improve their net operating profit after tax margin to 8% compared to minus 67% in 2019, estimated minus 12% for the trailing 12 months. For comparison, by the way, Grubhub captured 55% of U.S. delivery app, and their margin is 10%. And then when competition flooded the market, their market share fell to 18%, and now their net operating profit after tax is only minus 9%. DoorDash is also going to need to grow their revenue by 35% compounded annually for the next 11 years. Basically, this would require them to capture 56% of projected 2030 global food delivery spend. And that's compared to now around 16% for the trailing 12 months. So that's not to mention that while they capture this huge global market, which they need to increase, they will also need to improve their margins from minus 12% currently to 8%, which is much higher than most of its competitors. Another major issue that investors should worry about is the ongoing regulatory war between the companies and the various states and federal governments. So specifically, I'm talking about Dashers or DoorDash delivery people being classified as employees under federal or state law, as opposed to independent contractors, which is what they're currently referred to and classified. So the last couple of years, a growing number of states, including California and New York, are pushing to reclassify their contractors as employees. So what does this mean? Well, changing Dashers, as they call them, classification to employees would require the company, DoorDash, to treat them like employees by essentially providing them with a host of benefits, including sick pay, unemployment insurance, workers' compensation, etc. As a lawyer, by the way, I know that could really dig into business costs. In fact, in their effort initially to fight against the push recently, DoorDash spent $48 million to help pass something called Proposition 22 in California, which essentially exempted the company from a state law that would have required them to treat their couriers and drivers as employees. So that's a significant spend. So this is all to suggest that while people are very excited about DoorDash, the largest U.S. food delivery service, IPOing, and so therefore it's probably incredible and amazing, and I can get in so early. I think there are real concerns that investors have to take into account when thinking about putting their money, in this what I see as a very risky play. Here's the thing. Yes, their numbers have grown improved over the last couple months, over the last couple quarters, but think about it. There's a global pandemic. This is a business that literally, if there was like a wet dream for a DoorDash, it would be a global pandemic when everyone had to stay in their homes, and food would need to be delivered. So this is their best case scenario. But still, look at the numbers. They couldn't even keep up GAAP profitability more than one quarter. So what happens after the pandemic? You know what's not going away? The pandemic is likely going to go away. But you know what's not going away? The competition, the potential for regulation, the increased costs because of the competition that's creeping into the market. These are all real things. So I personally would not invest. I would wait at least till after the pandemic for a few months, for a few quarters, just to see how they fare after the pandemic, after everybody's outside and people are not demanding delivery in the way that they did for the last couple months. And then I would see about regulation. I would see about how they compete, how they face their competition. And then only after that, if they can prove that they in fact do have a really good business model with, good leaders and a good plan, then I would, think about investing in the company. But I personally would feel very uncomfortable putting my money there. Now, it's your money. You have to do your own research. I'm just a lawyer with a passion for finance and for stocks and for the market. But you really have to do your own do your own research. I did a lot of research for this, but it's ultimately your money. You're putting it there. Depends about the level of risk. Look, I could be wrong. It could shoot up, because of people are putting their money everywhere. Like everything's overvalued in the market to a large extent. So who knows? In the short term, it could shoot up. But ultimately, when you weigh the pros and cons, when I weigh the pros and cons, it seems like a very risky bet. It doesn't seem like that once-in-a-lifetime opportunity. And bear in mind, there are other very good places and very good potential companies to put your money in. Think about Airbnb potentially. That's IPOing this week. I'm not saying that that's where you should put your money. I'm just saying, look at that, and then compare. Where can I achieve the returns that I want to achieve as a long-term investor? So thank you so much for watching, guys. I really appreciate your time. Please do your own research. Also, please like, please subscribe, and we'll see you next time.